There is a lot you can do to raise capital when the deal is sweet, when you've got a great deal. I'm going to bang out the first two traditional forms of lending. You've got the owner-occupied, FHA, you get the VA, you've got the conventional, and then you've got the commercial side, which is a conventional commercial loan, typically 25% down or sometimes 30% down, depending on the market, with a 5-year annual renewal. So the term is 5 years, typically stretched, amortized over 20 to 25 years, although Ron and I are in a 5-year AM with a 30-year product. Commercial has yield maintenance. Typically, if you pay off the loan before the 3 to 5 years, you're paying a fee. Typically, it is a percentage of how many years they're putting on you. It can be anywhere between 3 to 5% maintenance yield. So if you bought something for $1 million and you paid it off too early, we'll say you refinanced it in year one, that could be a 5% fee on the total amount borrowed. So if you're borrowing $1 million, that could be a $50,000 fee. Commercial is a great product as an end game, but it may not always work on the acquisition. It may not always work smoothly on the acquisition. Some of the rules can change in commercial. Some of the rules can change where you don't have to bring the full 25%. Sometimes you only have to bring 10% or 15% if you can get the seller to bring the other 10 or 15%. They still want to see their equity position. The bank still wants to see their equity position, but they don't always require that it be you who brings it. They still, for the most part, want to see at least 10% skin in the game. Asset-based lending is commercial lending. Asset-based lending pretty much froze up during COVID, although we do see it opening up now. So we may be able to start buying deals again based on equity, LTV, loan to value instead of loan to cost. Loan to cost is if the property was $2 million, then they would lend, we'll say 70% of that. So that would be $600,000 down payment you'd have to bring to the table. If they went LTV and that same property was actually worth $3 million, now you don't have to bring anything to the table because you have $1 million in equity day one, and asset-based lending would allow you to bring nothing to the table, nothing to the closing. So that's why commercial, for the most part, is a much easier stream of lending to go down. The problem with it is the closing dates are somewhere between 60 to 75 days. So in the larger deals, the closing timeline can be a little bit bigger, which is generally okay because nobody else can close faster than you in that arena. Unless you raise private capital, unless you go with private investors or you go with hard money. In order to do that, you'd have to have a stellar deal. The deal would have to be absolutely killer, or you'd have to raise enough to carry some of the loss of the monthly payments and then refinance out. Being careful that anything you do buy with high interest rates, you could pay. Ron and I have put ourselves into some really sketchy situations when COVID hit. We had this great deal. We were in 12% interest, and then the refi took 16 months. Very, very difficult to swing that. So we ended up raising more money, making sure we paid all of our bills, and then we sold 2 condos, and it worked out. We came back into the game, did the refinance. Now we're sitting in a really great position. If we didn't have the other buildings in our portfolio to cash flow, that could have been a very risky situation for the average investor. If we didn't have the muscle to go and raise capital in addition to what we already had borrowed, that could have been a deal killer for a lot of investors. Knowing that there is always money. If the deal is good, if there's still meat on the bone, there's always money you can attain, makes the deal worth investing in. If that deal didn't have equity, we wouldn't have closed on it. The deal really is what bases the lending, but you're the one hunting for the deal. So you are what bases the deal itself coming to you. There are $1 million deals. There are $10 million deals. There are $100 million deals. There are $1 billion deals out there. And so it's you who decides what you're going after. And so the first step really is to get comfortable with how much money are you willing to borrow. When it comes to traditional lending, I think that it has a place for all real estate investors at all times. We always want to get to traditional. Always. Our goal is always traditional. Even when we're doing seller financing, eventually we want to get into a traditional loan. It's just better financing. The interest rates are typically significantly cheaper. Right now, they're 3, 4, 5%, depending on the product you're going into. And they are long-term loans, 30 years, 25 years, 20 years. These are great terms. These are great institutions and they have really great systems. Sometimes they just don't swing the deal though. Building's vacant, you're not going to get a commercial loan on it right now. Just not possible. Sometimes you could get a construction loan depending on the type of deal you're doing. But if a building is vacant, traditional lenders are not interested in taking that deal. They base their deals on cash flow. They base their deals on as if it's a business and they're taking in a business that makes money. If it doesn't make money, they don't want the deal. Banks aren't dumb. Banks want the money back. So when they invest in a business like real estate, they make sure that that asset is cash flowing. Some of the traditional lender limits are that they have long time frames, 60 to 75 days. Even in a conventional residential mortgage, you're still looking at a 30 to 45 day closing. These can sometimes hinder a deal. If somebody else comes in and can close faster, you may miss out on an opportunity. So these are some of the limitations to traditional lending. Another limitation, they really care about the credit score. The credit score means a whole heck of a lot to traditional lenders. Also, sometimes your own personal finances come into play. They'll look at your global DTI, global debt to income ratios, which is not just the building, it's also you as well. And so you've heard a lot of investors say, yeah, I don't have a job, so I'm going commercial and that's how I'm going to buy this property. That only works if your global DTI looks good, as long as you're not making less than you're spending. So they're still going to look at you on some level to make sure that you have financial intelligence, to make sure that you're paying your bills. Because remember, the bank only makes money if you pay them back. Yes? Another detriment to the banks is they are going to require appraisals. 2 months of bank statements, 2 years of tax returns. Sometimes they're going to want a PFS, personal financial statement. So there is a lot of paperwork working with the banks. Now you know why I have Ron do it all. It's a very litigious process to go and get a refinance done, to go and get a loan done, to do an initial purchase. So there's a lot of reasons why working with the banks is a pain in the ass. The benefit, low interest rates. The other benefit is they don't want your equity. Another limitation to the banks is they don't like to see money coming from anybody but you. They want you to have skin in the game. Since your name's on the deed, remember what banks look at, names on deeds. Since your name's on the deed, you're the only person they could go after. And so they want to make sure that the money's coming from you. You've got skin in the game. Residential lenders are a little more stringent. They're a little tighter. They're a little more careful about what they're lending. Credit scores will be a little bit higher.